The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. I know it's been a while since we last chatted, but we're happy to be back. Happy to welcome my co-host, Elliot Turner of RGA Investment Advisors, and Shaun Heelan, our special guest today. Shaun is Chief Investment Officer at MAAT Investment Group based in Munich. So we have a lot to cover today, lots of insights by Shaun. We're going to get into some ideas and case studies that'll be good fodder for all of you. To start, we're going to kind of talk about Shaun's investment philosophy, some of his and his firm's views on the complacency that's been in the market and some concentrated risks out there. We'll have a bit of the AI debate where Shaun has some great insights. And let's get right into it. Maybe we'll start, Shaun, with kind of your background and the story behind your firm. Tell us a little bit about your path in investing, maybe a few lessons you picked up along the way, and then kind of how the core team came about at your firm.
Yeah, well, listen, first of all, it's a pleasure to be with you both. So thank you, John and Elliot, for having me. And please tell me if at any point I speak too quickly or if I go off on a tangent. I have a tendency to do that. So don't be shy about correcting me. Yeah, I guess my path in investing has been a strange one. It's been a long and winding road, and it's been led by curiosity, I suppose, like a lot of people who are in this field. And I think all three of us are the same there. I started 24 years ago now at Goldman Sachs in London. So I'm Irish. I was born and raised there, and I was recruited by them, having done a master's in high performance computing, which I guess it gives me some lens or some expertise or ability to speak about the current debate in AI. So I had a great time in college, went over to work in Goldman as an intern originally in the summer of 2002. It shows how old I am, I guess, but it may occur in your memory what was going on at the time. So this was, right in the middle of the collapse of the dot-com boom. And what's lesser known, I think, especially for an American audience, is that there was a huge dot-com boom in Europe as well, especially in the telecoms area, anything related to that. And there was an underdeveloped high yield market in credit that was trying to be developed, similar to what you'd seen in the late 70s, early 80s through the early 90s in the US. And that market imploded itself. So that was a lot of businesses with a lot of financial leverage, mixing operating leverage. And I was there just as that really started to kick off on its worst front in 2002. So I was an intern in the summer. I was very fortunate. I got an offer to come back, and they asked me to start early in December because I was finishing my thesis. And the only reason I elaborate on this is by the time I got back, half of the trading floor, Goldman had 2 floors in London with a bridge between them, Peterborough Court and Fleet Street. Half the trading floor had been fired, just gone, like a neutron bomb had gone off. And that really impacted me. It was very noticeable. The mood had changed, obviously. And I think it's informed my career ever since. So I came, I think, with a natural sense of conservatism, but it created a heightened sense of risk awareness of what can go wrong in the markets, how quickly moods can turn, and how volatile the industry is. It also taught me, as one lesson, is that the downside is the thing you need to consider first and foremost all the time in investing. So you can have prolonged periods where things look very easy, where it doesn't appear that you have to do any work, where it appears that conservatism is a terrible mistake, that you're old and past it. But when the correction comes, or when sanity prevails, better to have been conservative all along. A bit like the GMO message that has been sent around for 20 years. And I also remember at the time Buffett talking at the Sun Valley Conference in 99, and a book coming out shortly afterwards called Bull, talking about the same thing, how he had predicted that equity returns for the next decade would be in the low mid-single digits. So that had a huge influence on me. I was very lucky that as the high yield market was imploding, companies were in big trouble. Goldman in London, especially, was a very active merchant bank. So something different to what you have in the US. So it would be almost like having a proprietary desk, but that makes more structured long term investments internally. And they were very famous for this. So I was put into a group that ended up doing two large rescue financings, one for Vivendi, which was a much bigger company at the time and actually owned the Universal Music Group and studios and whatnot. So it's interesting to see that in the media again. And then Rodia, a French chemical company. And because we took merchant risk on that deal, it ended up being probably the most profitable thing in fixed income at Goldman that year. So I actually did not particularly enjoy that. I had joined a trading desk, but I ended up doing this more kind of merchant bank capital raise role. So not really what I wanted to do. I was going to leave and head back to Ireland to potentially go work at Google. So they were opening up over there, and obviously I had a computer science background for my master's, and I was persuaded by friends and my father to go visit the States because I'd never been to New York. And they said, you can have a holiday. They have a training period at these investment banks, as you may know. So that's what I did. I went over for training. And again, I was very fortunate. It turned out that my bosses in London were quite fond of me. They thought I'd done a good job. I'm a very blunt, honest person, probably too honest if you listen to my wife. So I had told everyone before I left London that I was probably going to quit as soon as I got back. And they had given a heads up. And so after a few weeks, they came to me and said, would you like to interview with some desks in New York? I loved New York from the moment that I landed there. And I said, that would be perfect. So I interviewed with a few desks. I was fortunate. I got offers from pretty much all of them. And I joined the mortgage-backed trading desk at Goldman. At the time, Goldman in non-agency mortgage-backed securities was not a major player. So they might have been 12th or 13th out of 16 or 17. They were very active in the agency mortgage space. So Fannie Mae, Freddie Mac, and TVA mortgages, stuff like that, and CMOs, but not in the other space. And again, you talk about being in the right place at the right time. I had seen in London and worked with the trading desk and the quant group on CDS contracts. They were quite active in London. And the mortgage side in New York had not really seen anything like that. There was an active market in total return swaps. The memory of the 98 crash, the LTCM crash, was still very present in people's minds. And the lesson from that, because that was right at the epicenter of the 98 crash, all these long-term trades were in, for the most part, the ones that killed them were in basis trades on swap spreads against various mortgage products. They had to hedge a lot of risk, a lot of the warehouse risk. And so they were using total return swaps for this. Again, I was very fortunate to be a part of a group that saw that we could develop that market further or make ourselves more competitive. So the big disadvantage we had at Goldman at the time was we would be costed on our balance sheet with a high equity proportion, quite appropriately so. But if we were competing with the likes of Barclays or Deutsche Bank or money center banks, they would charge their trading desk a financing charge more like what they would get in the money markets, which was LIBOR minus. So we had about an 80 basis point disadvantage on anything we held in inventory. May not sound like a lot, but the average inventory was 2 to 3 billion for each of these trading desks, whether it was CMBS or subprime and Alt-A whatsoever. So yeah, we proposed that we develop a new type of product, which was pay-as-you-go CDS. Something similar was happening at Morgan Stanley at the time, but we ended up getting a big lead and dominating that market at Goldman. And so, yeah, I was part of the group that developed what became the standard contract or confirmation for subprime and CMBS pay-as-you-go CDS. The first trades done were actually bespokes, the famous Abacus trades that was done about a year before anything else. Those then became the standard for ABX and CMBX. Later, TABX kind of carried on the same thing. In addition, the Goldman model that I'd helped the quant group with at Goldman to develop became the market standard model for those CDS contracts too, as it pertains to the indices, ABX and CMBX. So as a result of that, I was negotiating for Goldman as part of the dealer group as to which model should win. And we won, and everyone thought that I was a lot more senior than I was. I was an analyst, but people thought I was an MD or a partner because I had a deep voice, I guess, and I was Irish. So I started getting offers from every bank. Actually, the best one was from Countrywide out in California, which was tempting, but I could see that there might be problems there down the road. So very fortunately, I did not take that step, and I went to Merrill Lynch, where I ended up running their correlation business after 6 months, and originally to trade single name credit default swaps and mortgage-backed securities. So there I was very fortunate again. They handed me a business they'd had for 2 years in correlation, hadn't done a single trade. We had very low budgets. I think in the first year, I was asked to make 5 million or so in P&L in total, which I know sounds small today, but it was meaningful for them there. We made 45, and then the next year we made 1 billion plus, and every year thereafter until I left, we made 1 billion plus with a team of around 3 or 4 people. So that was my experience in the sell side. Again, I would say I won the lottery multiple times over. Working at Goldman with some of the best risk takers you can find was an amazing training ground, and I really learned everything from the ground up. I would work from 6 in the morning, 6:30, and go home at midnight often because I had no friends or family in the US. At Merrill, we had a great distribution force, really brilliant people all around the place. It just was not as well organized or cohesive as Goldman at the time. And again, because we were so profitable, I got to see a lot. So if they had problems in Japan or if they had problems in London, often very big problems, because we were so profitable and we could figure things out quickly, we had built good analytics that could be deployed across the firm, they would parachute me or my team in to deal with that. So I got to see an awful lot of what happened within Merrill leading up to the GFC, and also to interact with very senior management, right up until below the CEO. So saw a lot, learned a lot about how people behave under extreme stress, learned a lot about managing risk. So when you're dealing with mortgage-backed securities, in a sense, you can apply it to equities. I always loved, and I was always a fan of Warren Buffett. And he had that quote that, when you're looking at an equity, it's just a bond with undefined coupons that will come for an indeterminate amount of time. I'm paraphrasing, but it's roughly that way. The perfect training then for me was to be doing that in structured products, whether it's MBS or anything else or a CDO. And the beauty within that is you go from a spectrum of ultra safe securities with no uncertainty around timing at the front of the capital structure, it's AAA, all the way down to things that are incredibly levered, the residual or the bottom or the equity, if you want to call it that. And you're playing with a variety of assumptions, and you get to see what the results are every month. So what you predicted versus what actually came out, surveillance report. So fabulous learning experience for me. I felt like I'd learned the principles of what makes a very good trader, how to evaluate risk, how to think about risk taking and liquidity in particular, and also about how to time or behave when you're in a marketplace. People are doing very silly things. It's always difficult in any industry when your competitors are doing silly things to not copy that, but we found ways to manage it. So yeah, that was my background in fixed income. It's a weird pivot. I then went to the buy side with Brevin and Bluecrest, trading mortgage-backed securities, caught the upswing of that. And finally, I thought the mortgage trade was over, and I made a crazy career move. I took a 50-to-1 pay cut and moved to Munich to learn how to value companies and invest in equities. So that's a very long-winded open from me, and then I'll pass it back to you guys.
Great. Well, that's really helpful, fascinating background there, Shaun. I think there's a lot of lessons that you took from that and that you're applying now at MAAT. So let's talk a little bit more about that. I know that MAAT has a highly concentrated portfolio, a value-based philosophy. Contrast that maybe with the concentration we're seeing in the tech-heavy indices and passive investing. So let's talk a little bit about your macro view, if you will. In your Q4 letter, you also referred to some cracks that you're seeing in the credit markets. So I'd be curious if we could get into that a little bit as well.
Yeah, absolutely. Thank you for that, John. I think when it comes to what we're doing at MAAT and the principles we apply, or how it relates to what I'd done earlier, again, it's a bit like Buffett. I think that the securities that you're investing in or the tools that you're using in building a portfolio, they can be quite different, but the principles of how you use them, the philosophy you apply there, you want to have that as a solid foundation. If it's built on granite, it will last for an incredibly long time. If it's built on sand, it will fade away very quickly. So anytime you're looking at things and you confuse a trade for an investment, I think you get into trouble. A trade can be built for the short term. The narrative or the premise behind it doesn't really matter. An investment has to be very different. And I saw that firsthand. I saw people who were trading products that were built for duration succumb to short-term assumptions. They thought nothing would go wrong in the short term and they will be able to get out. This idea that I can always exit. It's kind of what you're seeing in private credit now. So that the premise was, I'm going to take 5 or 10 year loans and I'm going to put them in a fund where you can redeem the equity within a month. It's the classic asset liability mismatch. So what I learned on the structured product side was really how to think about what assumptions you're making. You're always making a ton of assumptions. It's a very dangerous thing if you don't know what those assumptions are. In structured products, it's quite explicit, or in MBS. You know exactly what you're dealing with on CPR or CDR recoveries, and you can do that down to whatever level of specificity you want. At the property level, it could be at the MSA or the zip code, anything like that. The same principle applies when you come to investing in corporate debt or to investing in an equity. It's just the variables that you're using that change. It's the same principles applied all the time. Are you being thoughtful about this? So that I'd say, step one would be, do you know what assumptions you're making? A. B, do you understand them well enough to make a reasonable parameterization? And C, are you checking to see if you're correct or not? I love a quote from George Box, all models are wrong. They're all simplifications. Some are useful. So we bring that to the research side here. We try and build our approach in looking at companies in a very specific way. We try to be very detailed, as if we were going to own the company for 10 or 15 years. I have taken companies private at my prior employer. And we really understood these companies as well as the owner and founders. We had that happen a lot, where we would sit with them and they would be shocked maybe at the end of 2 hours how much we had learned. It was not uncommon back there actually for some of the CEOs to come and invest with us afterwards and stay for many years. They were some of our best investors. So I think it's that. First of all, if you're going to use a model, use it for what it's useful for, and know the assumptions you're making, know where you're strong, know where you're weak. That goes back maybe to the Munger comment on, or Buffett comment on, knowing your circle of competence. I think you can expand that circle all the time, but you've got to do it slowly, and you've got to check if you actually have learned. The illusion of knowledge is a very dangerous thing. So we deploy that actively. When we're looking at a company, we do very deep research. We'll prepare a primer report. We'll ultimately prepare a model, but the model is not built for me. It's built for everyone else in the investment group. Within that, the assumptions are very clearly laid out, always at the top, the outputs at the bottom. And we just treat the model as a way of sensitizing things. And it's a way of reflecting how we think about the business. It's a gross oversimplification. Anyone who's run a business knows that. You can try and look at it through a spreadsheet. Everything looks simple as a spreadsheet. It's far from that in reality. The other thing is that we're hyper aware that all businesses are really just people when you get down to the end of the day. A better group of people with a better sense of philosophy, shared values, who communicate well, will get much better use out of the same assets as another group who have poor incentives. And so we're always trying to look at the qualitative. I think, I'm a huge fan of Nick Sleep at Nomad Partners. And I think if you listen to him toward the end of his career, he was constantly talking about the qualitative aspect of investing. If you listen to Buffett and Munger over the years, they've been asked this a few times, they would say it's 99% qualitative. But I think for people who are new to investing, that sounds silly. But to me, it's kind of obvious through experience. And the same was true. It might be contrary to what people expect. The same was true for mortgage-backed securities as a GFC. It was how you thought about what could happen in the world. And there's a great quote from Jeff Gundlach talking about people trading subprime and in early '07 getting very excited because spreads exploded. Or sorry, late '07, I should say. What they failed to realize, though, was that spreads were exploding because rates were falling very rapidly, interest rates, government rates, and that was because a crisis was unfolding. And so you have to have that nuance, I think. Be thoughtful about what parameters are happening. Be thoughtful about what can happen, even if it hasn't happened before. So we try and bring that sensibility to MAAT. When we founded the firm, we founded it based on a very strict set of criteria. We wanted to make sure it wasn't set up as a trade. We had one good trade to do. We wanted something that we could build for 20, 30 years and be very proud of. In order for that to work, and I'd worked at lots of different funds, I'd seen some succeed, some fail, many friends succeed and fail in different funds as well. I just went around and inverted the problem and thought about what were the common factors that made those firms fail and why. And almost always it was because they had not set out the rules of the game ahead of the time. For the people who are in there, they did not have shared values or principles. And it was ultimately the people tearing each other apart. It was sharp elbows. And, after a run of success, maybe people started saying, well, it was all me, all that. It was either that or you got a situation where people felt disrespected and disengaged. One of my pet peeves in the investment industry is that you get this incredible brain power. You get these remarkable people. They've worked hard all their life, remarkable educations, very thoughtful. They come with an incredible work ethic, and they get into a firm, and suddenly no one listens to them. They don't have a say. They feel like they're just furniture, and in many cases, they may even feel that they're just for optics. So we have a large investment team, but they don't really impact anything. And the analogy that I would make there is that you can have, the engine of a Ferrari, but if you've got the transmission of a Fiat Panda, it's not going to work well. So what we tried to do was build a firm where everyone on the investment team has full engagement. So when we have an investment committee meeting, nobody shows up ill prepared. There's a prime report that's gone through it. And to the extent that there's a difference of opinion, and there always is, we really encourage that, but we have to see it parameterized in some way. It doesn't have to be the most accurate thing, but it means that people are thinking. So when it comes to making investments, everyone has a say in it, everyone has thought about it deeply. Their point of view has been expressed, and it's active engagement, not passive engagement. And that's really important, I think, to get the best out of people. You can get people who aren't the most experienced in every aspect of investing, but there might be something about a given company they know really, really well. So, yeah, we've tried to build up that way. On concentration, I would say I think it's one of the most misunderstood things in investing. So, if you were to look at the GFC again, the big short, the equivalent of what we had on, that was in effect a very concentrated bet. It just had incredibly asymmetric payoff. So we were risking in the book that I had, say 45 million maximum loss. We had call options that we could get the stuff back, but we stood to gain 6 billion over 3 years, which is, close to what happened ultimately. That's a crazy thing to turn down, especially if you think the odds are massively in your favor, which we did, but it was unpopular at the time. Likewise, if I go to the Euro crisis in 2011, 2012, we were buying heavily distressed mortgage backed securities again. There was a change in regulatory capital rules for both banks and insurance companies. So Basel II and Solvency II, Basel two and a half and Solvency II, that created a rush to the exits in about 6 months in 2011. Because we were well prepared for that, we'd studied what the impact was likely to be. We realized that a lot of the people holding the securities did not realize what the impact would be on them. We had 100% cash, if you like, for that space, and we're able to deploy it and buy securities at 3 to 5 cents that have been trading at 70 to 90 cents 6 months beforehand. So we didn't know that it would get that bad or that the opportunity would look that good, but we knew that there was a decent chance of it. And the opportunity cost for us not participating in that window period and before was only about 7 or 8% per year. We could live with that. The reason I mention this at all is just to say, in that case, we again concentrated 100% of our portfolio, or my portfolio at the time at Brevin, in those securities, and they made 100% a year for the next few years. I don't think concentration is good or bad. I think it's a tool, it's a form of leverage. It can be very bad if you don't know what you're doing. It can be very bad if you pay the wrong price. It can be terrible if you're in with bad partners, which can often happen if you're in public equities and you've got an unstable shareholder base around you or a major holder. So you just have to be mindful of that. I wouldn't say it's something that should be used often. It's just if you find a situation where the downside is incredibly limited and you can demonstrate that or know it over 2 to 3 years, and the upside is hugely asymmetric and positive, maybe a 3, 4, 5, 10-fold or more, when you see those opportunities, by definition, they're quite rare. In my experience, they're quite small as well. Usually something very bad has happened. You've got to go for the jugular. And that's, I think, again, something misunderstood here is you'll hear that from Stanley Druckenmiller. He'll say he learned it from George Soros. But Buffett and Munger did the same thing. I mean, Buffett had securities that were 40, 45% of his portfolio at different points in his career. Munger had something similar. Joel Greenblatt, it's the same. Obviously, Chris Hone, you look at his performance last year, over the last 20 years, it's incredible. And he runs a concentrated book too. So I think in the hands of someone who knows what they're doing and who's very disciplined and who's good at assessing risk, it's a very powerful thing. And it's one of the few ways to outperform the market. That married to a longer term horizon. I always find it funny because people push back, and it's understandable why, because there have been so many famous blowups. I won't mention any names, but we all know them. So there's a high risk for that, and there's a high awareness for it. It's just, it's like watching the news. I think what I find most surprising at the moment, and you alluded to it, John, is the amount of concentration that's in the marketplace right now. So if you look at the S&P or the Nasdaq, just from what's going on in AI and some of the related things, you're talking about concentration. We haven't, I guess we're at the highs actually on the technology side. If you were to aggregate that within the S&P, exceeding what you saw in 99, 2000. it's kind of remarkable. And if you look at what's going on with the MSCI World and how much of US indices are in there, if it's 70% plus, and then apply the concentration of technology within the S&P, which passes through that, it's really quite overwhelming. And when I say it to people when we meet with them, do you know how much if they have a passive investment or a tracker? They're always shocked to hear it. I mean, less so in the last few weeks. There's been some mention, but they were shocked to hear it late last year. The last thing I would say on that front is if you look historically, and this is ironically, it's true on the debt side as well for corporate debt. If you look at prior periods where one given sector became extremely concentrated, so you mentioned the letter that we wrote, industrials or the go-go companies in the late 60s, consumer staples or the Nifty 50 in the early 70s, energy companies in 1980 or so, technology companies again around 2000, and then financials as a class around 2006, 2007. Anytime they got up to a very high percentage, 25 or higher or 30 or higher, what happened in the following 5 to 10 years tended to be not pleasant. So yeah, I think we'll deploy concentration because we think it's a competitive edge, because we think we know what we're doing. We think it's something that should be embraced, but it's with the proviso that you really understand what you own and that you've got good discipline about assessing or underwriting what the downside is versus the upside. So very volatile, very dangerous thing. It can be very powerful for good in the right hands. It can be disastrous in the wrong hands. We like to think we're the right hands for that.
Great. Well, fascinating stuff. Let's bring in Elliot. Elliot, I don't know if you have any thoughts on this concentration risks and so forth, or if we should move on to the AI debate.
Yeah, I actually wrote about this recently in my own letter, and I'd been thinking a lot about the question of concentration. So, Shaun, I would love to hear your thoughts. One thing that I've noted, and I had Claude Code do this phenomenal study for me going back the last 20 years, but single stock volatility is meaningfully higher. It's been trending upward and then has exploded since COVID during that time frame. So, how do you think about concentration in a world where the volatility of any given one stock is far greater than it had been in the past, and what that means for underwriting positions, the required margin of safety, and how you build a portfolio on the whole?
Great question. Great question. Thank you, Elliot. So I think what you described there is an undeniable fact on increasing single stock volatility. I think in some ways it's a positive, depending on what structure you have, it's a negative. I would take it as a net positive, thinking opportunistically. So we have this in our letter as well. There's a symbol in Chinese and Japanese that says crisis and opportunity together. And so when you talk about volatility in that sense, if I go back to when I was at firms like Bluecrest, DW, and Brevin Howard, much like you would see with the multi-manager or pod shops today, they have very, very strict risk limits. So if you lost 6%, you were pretty much out of a job. So I used to equate that to driving a Formula One car with a spike on the steering wheel. You'll get around, but you're going to be very careful. I think those firms are amazing on the multi-manager side, also on the macro side where I worked, but it is very limiting and it can be very frustrating. And they're selling to an institutional audience. Why I say the increasing volatility is both a risk and an opportunity. If you are in one of those seats where your risk limits are strictly defined by value at risk or VAR or stress limits, as volatility picks up, there's typically a 12 or a 24-month look back period. It inhibits what those people can do. That they have to knock out of the market. You'll see it with quant funds as well. If all goes above a certain level, they have to get out. If, on the other hand, you run a structure with investors who are like-minded, who understand or think more like business owners, so they're entrepreneurial, they realize that when other competitors get knocked out, you can do quite well. You have a different timeline by definition, and you will not be constrained by VAR. So we have deliberately gone for a niche and tried to speak to people in a manner that excludes anyone who's looking for that VAR-like model. We are nothing like any of those firms. They do a great job. I would hate to compete with them. We go to people, and it's typically high net worth individuals or family offices who have built a fortune themselves, understand that business is unpredictable, and embrace it. And we see that a lot. So how do we get them to be comfortable? How do we get them to understand that the vol could be an opportunity? We just try and be as transparent and honest with them as possible. So we explain our thinking, we go through it, we invite them to critique us. So, you mentioned the letter, John, a couple of times where We'll say for any of the case studies we do, come in if you disagree with an assumption, or if you think that we missed one, or if you think we're asking the wrong questions in particular. We want to know. We want to know where we're wrong and why. And that tends to build comfort. So they know at least that we are thoughtful, that we've done our work, and that we're thinking in a way that they would think. And that changes it from a discussion about volatility or risk measurement as done in the majority of firms or conventional finance today to something more like a private equity investment, albeit one where you're seeing marks on an active basis. So I think the key thing there, and it goes back maybe to something else we alluded to, the asset liability mismatch, is making sure that we have investors who have a like mind to us. So I'm fine with the volatility as long as they are and they stick through it, they'll be okay as well. For some, we have a lockup. It's not for particularly long, 2 years or less, but for most, that's implicit. I think, again, going to the opportunity side of it, the more volatility you have, the more volatile those names, it often restricts, again, a lot of players from competing with you. The more volatile it is, the more opportunity you're going to see. So if I make the analogy, it's maybe easier to go back again to 2011 and look at those bonds that I was telling you about, bonds that were trading at 80 or 90 cents that trade to 5 cents. If you are limited by a VAR model, a VAR model, the VAR is going to look incredibly high and most people cannot participate. And indeed, that's what I saw with my competitive set. They just could not get engaged. The VAR was off the charts. It didn't make any sense. Again, VAR is a very useful measure for aggregating risk across a lot of securities and a big portfolio if you know very little about the things that are in them. That's what it was designed for. I think it originated at JP Morgan in the 90s specifically for board members so they could aggregate all risk into a number. The irony, as I recall it, was that it was very heavily criticized post long term and the blow up in 98 because it obviously didn't capture everything. And I think my ultimate takeaway for that is, for our approach, the VAR will look infinite and tell you not to invest when the price goes to zero, even if there's value in the asset. It just doesn't consider the value underlying it at all. So I think the more volatile it gets, the better it is if you're disciplined about how you enter, if you're mindful about what the upside downside risk is. And especially for our space, and Elliot, I should have said that up front, we focus just on Europe and in European small and mid caps. There's a risk factor here that goes into your question about volatility, which is path risk. So as a former derivatives trader, you have to think about this all the time. You can, the old joke goes that you can drown in a 2-foot river that has an average depth of 2 feet at one point where it's 9 or 10 feet deep. For our companies, when we're looking at them, we tend to get it right in terms of valuation, but that's not enough. So uh, if I look at a company today that's trading at say 100 million euros, and I'm convinced it's worth 200 million and it will get there within 3 to 4 years, but it's got some near-term problems that we're willing to endure. Again, we're willing to participate in a volatility path that others won't, and that's our advantage and that longer-term horizon. If it first trades down to say 20 million, so it declines 80% for any reason, we may still be correct. And now it's worth 10x, but we will not get the chance to stick with it because a private equity firm, or more likely today, an industry buyer or a family office will step in and buy it. And typically, if that's happened, if it dropped 80% and they bid 100% premium, maybe I was right over 5 years, but I've lost 60%. So when we're looking at it, and it comes back to the last part of your question, how do you mitigate this overall? So if you've got 5 or 6 or 10 names that are incredibly volatile in an environment like today, perhaps, how do you mitigate this or how do you manage it? And that comes back to the final thing, and it's something I used to do. I was a correlation trader. That's the correlation of the elements in your portfolio. So when we're building a portfolio, we are incredibly mindful of where the value will be in 3 to 5 years. We try to understand that really well and how the mechanics of the business work, the competitive dynamics. We're really underwriting it as if we were taking it private. There's limits to that because it's a public company and you can only do so much due diligence. But in addition to that, for every individual company or share, we're looking at the path risk. What was it in the past? What does it look like now? What events could come that are not related to operations? It could be industry. It could be another shareholder who might be a weak hand. It could be anything that might cause this to have a sudden gap down in price. And if that's likely to happen, we have to reduce the position size. Finally, there's the correlation. So just like you would see at the multi-managers, that's how they manage risk. They over-allocate capital on a nominal basis, but they're looking to lower the correlation. We look to do the same thing. So if you look at our first, second, and third, and even fourth letters, if you like, the fourth one's coming soon, you will see very disparate names. And the things that are likely to drive long-term performance are quite different for them. We hope that all of them will work out, but it's very unlikely that there's any one factor that would drive them lower in unison. The exception to that would be something like the GFC, where all assets fall in unison because capital is withdrawn, or it could be a war. But we've even seen it in our portfolio this year. Different names are performing on a different basis. So to us, those are the elements of building a successful portfolio. It's difficult to do it well because historical correlations are not indicative of the future, especially if you're looking at securities that have already had a big decline. We have to make a guess about that. But then we have a very different approach, I guess, to portfolio management and capital allocation. That's maybe our secret sauce. This goes back again to my background as a correlation trader and my partners. One has a degree in advanced mathematics from Oxford, another is an engineer. So we have built our own software and analytics here to try and think about how we parameterize these things. So we link all of our research all the way from inputs on the operating side down to a return vector. From that, we will get expected returns across scenarios. You will see some of the scenarios that we use. We use a simplified version in the letter. And then we run that through a modified version of the Kelly criterion. And that's just a bet sizing algorithm. I think Monish Fabrai had written about it a few years in the past. There's a great book called Fortune's Formula about that. It's a modified version. So when you're doing it for an array of assets in a portfolio, you have to think about the covariance. You can convert that to correlation. But if you get that right, it should give you optimal bet size. We don't use this in a crude manner, so we don't take the Kelly bet size. There's a lot of noise in what we're doing. What we do use it for, though, is to force rank our choices. So from first to 10th or 12th, whatever it is, we will look at this, feed in our return vectors, our expected correlations, and it will show us what the right order of priority should be from the implied bet size. And that forces us to stay on us. So one last thing, and sorry, I'll stop then. I know I drone on. What I've seen in many investment firms is you've got an incredible performance from a given asset, one asset, and it becomes something that's a marketing tool, and justifiably so. But the price might have gone up 2, 3, 4, 5-fold. For a given name, if it doubles in price over the course of a week, just for example, unless you think something fundamentally has changed for the business and the cash flows it's going to produce, the return has dropped by half. So if it was 20% before, it's 10 now. But all of the behavioral biases would lead that firm to say, boast about this position and leave it as a big size. For us, we're forced to address it. When we run it through this criteria, it's going to drop, if it was first, down to maybe fourth or fifth. And so that tries to keep us honest. So we've built the whole investment process to try and keep an eye on what's going on, making sure that we're not succumbing to biases. It's not immunity, but it's different alarms, if you like, that go off. So that's how we think about all of that. And I hope that covers the underwriting part as well.
Fascinating. Thank you, Shaun. Let's move on to the AI debate. There's a lot we can cover there. You have some very interesting views there. You've described LLMs as, quote, smart librarians, not scientists. You distinguish between information and knowledge. And if I'm correct, you believe essentially that AI will actually reinforce traditional intangible moats rather than destroy them. Tell us more about that.
Yeah, sure. I mean, I think, first of all, I think AI or LLMs are absolutely revolutionary. They're incredible. They blow my mind on a daily basis. So in no way am I or are we saying that this is not a revolutionary technology or it's not going to change the world or how people work. I think it's going to make getting the best use of the incredible compute power that we already have available to us just far more accessible and democratize it. So I think that's wonderful, in the same way that the graphical user interface did that before you had a command line. So I think that's wonderful. But where I get concerned, particularly as it pertains just to LLMs, is the idea that these things have an understanding or an intuition or feelings or empathy or anything like that. That it's just not the case. And this is not it's not a new problem or a new take on computers. So I don't know if have you guys ever heard of a guy called Joseph Weizenbaum?
Nope.
No.
The
Okay.
Bloomberg journalist?
Different guy. This guy was a computer scientist. He was a professor, I think, at MIT in the 60s. And so I'll mention, is it okay? It's related. It's tangential. If you're curious, I can talk about it, or I can just go to what we had written about.
Of course, go on.
Okay. So he did an experiment, more as a toy and to show people that machines can deceive and I don't mean a bad basis, but people can put emotions or characteristics or anthropomorphize machines as people when they shouldn't. And so to kind of demonstrate this, and it was very abstract at the time. And again, this is before the graphical user interface or anything like that. He came up with a program called ELIZA, ELIZA. I think it was in the mid 60s, I don't know, 64, 65, 66 or something like that. And what it did was very similar to what you see with chatbots today, or maybe the first versions of ChatGPT that you had seen. He just created a little algorithm that was pattern matching. And so what it would do, it would have you give an input. It would say, it, tell me about yourself or how do you feel? And it would look for keywords. And it would say, okay, if I see something, and it just had a lookup table. So sad, happy, feeling, mother, anything emotive, it would go through that and it would look for the keywords. And then it would just respond with a question. So if you said something, Elliot, like, I feel sad, its response would be, why do you feel sad? There was no logic. It was just a lookup table. If you said dream, it would say, what did you dream about? So it knew the why or the what questions from general pattern matching. That was it. And he thought that people would see through this very quickly, that this is just a computational trick. They didn't. It became a huge sensation, not quite as big as AI is today, but it wasn't crazily far off. To the point, I think, if my memory serves, in the late 60s, early 70s, people were legitimately talking about creating virtual therapists like Eliza, who people could sit and talk with. And Weizenbaum was horrified by this. He thought this is just insane. So much so that a decade after he did this, he wrote a book called Computer Power and Reason. And what he was saying was, from the ELIZA experiment, what you're seeing from the computer objectively is just a lot of calculation. It presents in a manner that is intelligible to us, but we're putting, a human face to it. And he said, no, it's just pattern matching and a scripted response. And his conclusions were roughly this: the computer can calculate, but it cannot understand. Just because the computer can do something or you can do something with it doesn't mean it should. And what he was referring to there was, he thought it was immoral in the extreme that people would push this as a therapist when it does not understand emotion, has never experienced loss. He just thought that was very misguided. And also, I think his final point was, don't confuse cleverness with wisdom. This thing maybe it has the appearance of memory. It's very fast. It never gets tired. But a bit like the analogy, Warren Buffett made about hiring people, he always talked about the three I's. You want intelligence, intellect, and integrity. But if they don't have the last one, you want to make sure they've got neither of the first two either, right? Because they'll kill you. They'll run you into the ground. I think the risk when you deploy these things is that you're attributing great intelligence. I think people often conflict or conflate intelligence with wisdom. They're not the same thing, which is one of the things we were trying to allude to. And then they hand over decision making to it. And that was his big fear, that people would outsource their thinking. And I think that's a big mistake. I mean, again, by way of analogy, if you look at the GFC, a very long-term cause of that was ratings-based capital calculations. And that goes back to a decision in the early 70s to create the NAICs, Moody's and S&P, and then later Fitch come along. And the idea, again, in essence, is these guys can assess the risk. Everyone at the time that happened through the mid 90s would not rely on ratings. They were doing their own credit assessment. But by the time you got to CDOs, people just trust that model blindly. And they didn't realize that the incentives had been perverted, if you like. So, yeah, I think when you look at LLMs today, on a very, very simplified basis, they're almost an elaborate version of predictive text in your Motorola phone from 20 years ago. They can do it in far greater depth. They can do it with far greater width, but they fail if you put them through certain tests. And there's a lot of evidence for this now that they if you give them too long a context window, or if you keep on questioning in the same context window, the results ultimately get very bad very quickly. It cannot get rid of memory. There's also, I don't know if you saw, there was a great paper released late last year about the artificial hive mind, which was, they tested, I think, every LLM in the market from the major brands, asking open-ended questions, what is life about and stuff like that. And almost all of them gave close to a verbatim response, just because of the way that they're trained in a recursive way. They're trained to give you back the average. So when you go to the analogy that we made of the librarian versus the scientist, the LLM is an incredible model for accessing and retrieving information that we already know, and putting it in terms that you might understand. So you can get it to describe it in a different way. It's like a great tutor. What is that based on? It's based on the idea that we know everything. So all knowledge is known at this point, and it's a way of retrieving it. But that's not how human knowledge develops over time. That's the whole distinction we were trying to make between information and knowledge. And when we say the librarian and the scientist, we cribbed that from Demis Hassabis, the founder of DeepMind. He has gone on record talking about this very subject multiple times. And he says, it is more like a repository of data. And it's a brilliant tool. Don't get me wrong. In the same way a computer or a Kindle is better, a Kindle can hold 1,000 books and you don't have to have physical copies in your room, right? It's revolutionary. This is similar, but it's limited. And so let's not confuse it for what it's not. And he gives, I don't know if you heard his idea of the Einstein test?
No.
Okay. So he you can find this online. Like he alludes to this, but roughly speaking, it was, and it's a thought experiment. If you went back to 1904, just thinking about how an LLM is trained and what it does, if you went back to 1904 and you only trained an LLM on all human knowledge up to that point, assuming you could digitize it, would it be able to come up with the partial and then general theories of relativity? And his answer to that, and he would know better than anyone, was absolutely not, because it's recurring back to the norm. What it would do is it would give you an answer in Newtonian physics. He had to do a lot of different lateral things and question key assumptions. So in that sense, how can it ever really create? And I think the answer to that, as LLMs are structured currently, is that it can't. And I think it's a similar thing. You can go back, if you look at Pluto, for example, for about 80 years, that was a planet. So depending on when you train the LLM, if it's before it's discovered as a planet, Pluto doesn't exist. There's only a certain number of planets in the solar system. If you go from the 30s on through the 90s, now Pluto's a planet, and then you get to 2006, it's no longer a planet. So which is true? And here I would go back to, say, Karl Popper, or the idea of humans advancing their knowledge, which is, all the facts we have currently are really just things we have yet to falsify. It's that kind of mindset. I know it inspired George Soros as well. With that mindset, you're always questioning things and things are going to change. An LLM doesn't think that. It thinks that I have been trained on everything in the world and that is the truth. And so I think that's the limit of it. And it has the illusion of great wisdom and knowledge, but it's just on what it knows. Humans have been fooled by things like this before. Like I said, there was Eliza back in the 60s. You can go back further than that. My son's an avid chess player. There's the Mechanical Turk that fooled people for a century nearly, playing chess. So yeah, I think that is the limit on it. It's still an incredibly powerful tool. It doesn't make it any less revolutionary, but you just have to be aware that this is purely a probabilistic extrapolation machine trained to certain answers that it's supposed to please for, and largely uniform. So I think it's like any tool, it's really powerful, or like any weapon, but you got to know what the strengths and weaknesses of the weapon are and how to use it.
So if I could ask one philosophical question here, and then also kind of ground it back into how to think about the moat of companies that sell intangibles.
Hmm.
So philosophically, right, read this book, Co-Intelligence by Ethan Mollick. I thought it was fascinating. One of his points is that actually the very fact that LLMs struggle with hallucinations, it's one of their greatest strengths and greatest weaknesses, because it does illustrate their power to be creative. That LLMs are in fact capable of being creative, but it's bounded, right? It takes a prompt, it takes some orchestration from the human to get to that point of
Yeah.
creativity, and creativity is in the eye of the beholder there. So curious your perspective on that, and then maybe once you speak on that, try to talk a little more about how they do some things that are quite powerful that are coded, for lack of a better word, into the intangible value of a lot of companies. So how do you think about whether the barriers to entry or the playing field tilts for those kinds of companies?
Yeah. So I think on your point about hallucinations and creativity, I think that's absolutely true. Actually, and if you want the paper afterwards, guys, please let me know on the artificial hive mind. I think you'll find it very eye opening and very interesting. You may not agree with all the conclusions from it, but it is a fascinating paper. What they were saying actually is exactly what you suggest, Elliot, which is the point I made earlier from that paper was that when you ask general open ended questions, you get a uniform response, whether it's Gemini, ChatGPT, Anthropic, Claude, whatever it is, they're all very similar, DeepSeek. So how do you get around this? How do you make the most of that? And that is just exactly, how do you embrace or how do you engage with the LLM? You have to ask questions that force it to deviate from what it's trained for. So it forces it to deviate from the most expected, most accepted answer, which is going to be average. It's a bit like the I don't know if you guys saw it when Matt Damon and Ben Affleck were on Joe Rogan, and he was talking about this for people who are developing script. So I think you can use this very well, and I think it can help with respect to creativity just by making you make a lateral leap. So I remember as a boy growing up, there were a lot of books by Edward de Bono about lateral thinking that my mother would kind of force me to read, and it was all about trying to get away from conventional norms, trying to get away from existing bounds, and think in a different manner. And obviously, I think when you talk about risk or taking it back to that, if you look at Buffett and what he described as a great investor or a great underwriter on the insurance side, it's someone who can imagine things that have never happened and really picture it vividly and reflect it and live it as if it was real or hypothesize. I think as it pertains to investing, that's where an LLM is incredibly powerful. So if you know how to direct it, if you know how to force it away from the average response, if you craft if you craft your questions or your process in that manner, you will get very good outcomes. One of the things we do, for example, is we will have a question all of our assumptions, find weaknesses in the logic, try to find facts that contravene what we've assumed or disagree what we're going on. So to play the 11th man, if you like, I think there it can be really, really helpful. I think the weakness of it, as you said, is more on the precision side. So there was a company I'd spoken to several years ago. It wasn't using an LLM, but they were trying to develop a model to deal with legal contracts. In a legal contract, every clause, every I that's dotted and T that's crossed has to be accurate. You're in big trouble if you even get an error rate of 50 basis points if it's in a key clause. As a former bond trader, it's a similar thing. You cannot have a situation where it's right 9 times out of 10. So, it's going to get the right price, the right yield, the right terms 9 times out of 10. And the 10th time, it's very different. So anything where you've got a model where the hit rate has to be really high or else the severity is really poor, I think an LLM where precision is required is going to be a poor choice for that. As it pertains to the intangible moats, I think it's a great question. I think it can be a little bit difficult to define. I'll tell you what we meant by that, and I don't know if you would agree with it, Elliot. I'd be very curious to hear your view on it then. It's really to do with businesses where technology might appear to be the front, but the strength or the moat of the business is something different. So an example of that, I think, would be Bloomberg. I've seen a lot of talk about this, or I see it in X or Twitter, whatever it's called now, saying, "Oh, I built a new Bloomberg. It's got these, I can pull this data in, or it can do an earnings analysis." That's a very small aspect of what Bloomberg does or what it's used for. It's really used for messaging. It's often used for portfolio management, their OMS, their PMS. In bond trading, I mean, you really cannot live without it. You're out of the loop. So it's the network that they have. It's their ability to take a lot of disparate data and put it in one repository that a lot of people are going to use, especially larger asset managers, and bundle it and make it efficient. I think they're amazing. I was a tester for them when I was on the buy side and sell side for many years. I think they'll be aided by this. I mean, one of the complaints that you had about Bloomberg in the past was it's very difficult to figure out all the commands. It looks like something out of the 80s, right? It's I don't know, type in bond go or whatever it is. I think if anything, the LLM interface will again it will democratize it. You're not going to have some person coming in and having to train you on everything all the time. So they probably can reduce the Salesforce intensity. The other thing is they've got, thousands of engineers who are brilliant, very well paid, highly trained. They can become either a lot more efficient or they can reduce that. And I just don't see a natural competitor to them coming around at all. They've got an installed base. A lot of people have built their processes and systems on that. That is the mode of that business. Another one, which is, I guess it's a company we'll come back to later. But if I look at a company like Edenred, an LLM is very useful for them. Again, they can probably reduce the number of programmers or make them a lot more efficient. On the positive side, it makes, and we wrote about this briefly, it makes a universe of customers that weren't historically available to them. So small and medium businesses, was not cost efficient for them. They had an enterprise type sales force. It makes those customers a lot more accessible. They can automate the initial part of the funnel in that process, get those customers in, and they benefit from the network. The marginal cost of onboarding them beyond that is very low. Maybe one more example, if you look at the UK, the car market there, the used car market, it's really dominated by a company called Auto Trader. So I know there's an Auto Trader in the US as well, but this one's quite different, and it has perhaps 90% share of value of classifieds going through the UK. That's a model, and that's all of the classified businesses in Europe, which were highly valued prior to this, have been decimated in the last year or so. Auto Trader's a notable case. It's gone from its all-time high, I think, down 50%. And the idea is, and it's understandable on a first pass or a 30,000-foot view, that, well, I can create a classified site very quick and very easily for free. The engineering barrier is no longer there. I don't think that's a reflection, again, of where the moat for that business lies. The moat for that business is that they are a verb in that marketplace. So everyone knows Auto Trader the way that you and I might know Google. That's where people go to search for vehicles. They have most of the high value dealers on board with them, even the ones that have a lot of very good internal systems. And they're the number one lead agent. And what they add in value in that case is really it's inventory turns. So used car sales in the UK, the actual sale of the vehicle as opposed to service or financing is a very low margin business, like 7, 8, 9%, depending on the dealer. What's critical for them is that they turn in the inventory over very quickly. They get low gross profits per vehicle. So if you turn it over only twice a year, you're not going to do well because you're using the same parking spot or whatever else. If you turn it over 12 times, you're fantastically profitable. What's critical to that is the quality of the lead that you get. Well, they have 90% of the traffic and it's organic. Almost all of it's organic. I think 96%. There's 4% paid search. So people are saying we're going to create an LLM, create a classifieds business, and all of the dealers will come to that. For sure, I think that the dealers will give their inventory up to somebody who wants to come in. It's free for them, but they're not going to pay a premium for that. And then you think, and this will go back to the LLMs can replace it easily, or Amazon using an LLM or ChatGPT. Can they do that? Well, Google pretty much owned all of search space, but they weren't able to displace Auto Trader over 20 years. Why was that? And it's because of other tools that Auto Trader has built for dealers that helps inventory turn. So this is inventory management. It helps them price their cars for exit to maximize that inventory turn. It also helps them to price up used stock that they're going to buy at auction. It can help provide financing partners for folks too. So when I look at something like an LLM, what is that going to do for competitors or that space? In our opinion, I think that the barrier to entry just got bigger for someone trying to create a competitor. And so I would encourage you, if you get a chance, and if you don't want to, I'll send you our research on this afterwards. You can laugh at it if you like, if it's really bad. But you can look at Hey Car, which was a competitor that tried to come into the marketplace. It was a Volkswagen sponsored business, and it was selling new and certified pre-owned vehicles. Huge support, large investment in the brand, 250 million, went nowhere. I think it didn't ever sell more than 1,000 vehicles a month. You could look at Cinch or Kazoo in the UK, which would be kind of equivalent, I suppose, to Carvana in the US. I mean, collectively, these three companies spent $1.5 billion plus trying to build a brand, could not compete. And the reason for that is, how do they get people onto their network? They've got a chicken and egg problem. They need to get people onto the network to make it valuable to dealers so they can charge money. And to get people onto the network, they have to draw them to the website and they have to pay for search. And that's a cost per impression or cost per engagement, cost per click, whatever you want to call it, cost per lead. What you're seeing now with Google, for example, is if you go on there, you get the Google AI answer at the top. That's stopping people from going to rivals, to Auto Trader, like Car Gurus and everything else. And it makes the cost you would need to pay in marketing to try and get users, or the customer acquisition cost, or CAC, a lot higher probably than it was 5 or 6 years ago. So when we look at a business like Auto Trader, it is so enmeshed in most car dealers in the UK, which is a very niche market itself, right? It's left-hand drive, it's an island. Who's going to come in to compete with them? And how could they? Where would they get the data? There are rules in Europe as well that prohibit or limit the ability for people to scrape data. And when you're dealing with a product that turns over 10 to 12 times a year, and it's a perishable good, a used car, I know it's like 5 to 6 years, but it's not going to go more than 10 years, for example. The data that you require to price it accurately to allow that turnover is very discrete. And who has the best data? It is Auto Trader. So I think the only way that a business like that could be negatively impacted realistically, as I understand things today, is if in some way one LLM came to dominate, which doesn't look to be the case as it stands, and started to charge a toll, right, for directing traffic that way. Again, I would point back to Google and say, well, if they couldn't do it and they were totally dominant for 20 years, why do you think an LLM would do it? The second thing I would say is, even if an LLM wanted to, does it make sense for them to get into this kind of battle with the dominant data provider who has a lot of market share? What is their threat? We won't include your results. Well, then you're going to miss a large part of the market. So I think when you look at it that way, the cost to try and build a competitor just went up a lot. And that's because the advantage for that business was never technological. It wasn't in the engineers or building a user interface where it's very smooth. It's in all the stuff that goes into it and the strategy of the business. I think it's a similar thing for Edenred. It's in their network. An LLM is not going to help you acquire merchants, go out to restaurants and sign them up, or other small businesses. If you've got an existing network, what it might do is make sales a lot easier or go to a wider network. It might make your engineering costs drop over time. So that's what we mean for certain businesses where the edge is or the moat is not the it's not the code. It's all the other aspects of the business, and the code helps that. We think it probably increases the barriers. For things where it's a simple automation tool, it's a different story. And there, I think people can get in trouble.
Terrific,
Yeah.
Shaun. Thank you. Go ahead, Elliot.
Yeah, no, Sean, I just want to kind of lean in on some of the points you made because I think it was fantastic and well stated, right? Like we're recording this just a couple weeks after that Citrini piece made a big impact on the software space. And integrations, regulatory barriers, unique data, fringe use cases, having a throat to choke, making sure that your software works in the morning and securing it. All these things are important. And I thought it was ironic that Citrini used DoorDash as one of his examples of where
Yeah.
agents will inevitably kill it. When, I followed the history of the company from when it was private, there were dozens of companies with very similar code where the UX looked similar. They even, in some cases, had similar number of restaurants, good overlap in supply. So, like aggregating supply was a challenge, but others did it too. And execution matters, and the way the business runs matters. And putting together all the other complexities, it's literally running a service, so it's not just software. So I think you made a powerful point, and just wanted to add that piece. I tend to agree. I know John's written some really good stuff though, on like there are some areas where the barriers to entry drop meaningfully, and the pricing power, the pricing landscape might change, where even just merely having the threat of being able to vibe code something might tilt how you approach it. And or you might have like lower headcounts at certain firms. So if a company can't evolve from like value based from seat based pricing to value based or consumption based pricing, there could be challenges on that front.
Yeah, completely agree. And I think your DoorDash example is a wonderful one. I wish I had used that rather than my own, Elliot. And I've read some of John's stuff. I think it's wonderful as well. I think you guys probably understand this better than I do. But I think you're right on the money there, Elliot.
I don't know about that, but I enjoyed hearing your perspective as well. So maybe confirmation bias, but I think you're onto something.
Great. Well, in the interest of time, we're going to move on to the three companies we wanted to touch on. Let's see if we can hit the highlights on each of them. Shaun, you alluded to Edenred. We'll get to that one. That's one of your newest portfolio additions. But let's start with a past opportunity, and that is a company quite well known to a lot of value investors, Vistry Group in the UK. I think it's a good case study of your private equity style due diligence, and that kind of made you reject this notion of it being an NVR of the UK, and also talk just a bit about your forensic accounting concerns on the company that were also a factor.
Yeah, sure. I'd love to speak about it. I guess it's timely because I mean, it's just a coincidence that they came out with results, I think last week, and an announcement about the departure of the chairman and CEO, who's kind of this cult figure, and he's had an amazing career, Greg Fitzgerald, at the top of that company. So yeah, I mean, very briefly, I guess for the audience, if you don't know it, Vistry it's arguably the largest home builder in the UK. It's first or second. It is the aggregation of three, maybe four, depending on how you look at it or how far back you go, different home builders in the UK. Why the analogy to NVR? NVR had an asset light approach to building homes. It revolutionized the model in the US. And probably most famous, I guess, is Norbert Liu, from Punchcard. And he wrote about this in the early 2000s and why it was quite brilliant. And the returns investors had. So, when someone thinks of a home builder, or at least when I do, I don't think of a business that's going to make returns like Microsoft. But if you go back to 93 or 94 when it emerged from bankruptcy, you made a similar return to what you made in Microsoft, about 18% per year. So quite remarkable. Why do I mention that? Well, we had prospective investors coming to us because we focused just in Europe. And one of the things that they kept on almost in unison, there's about 10 of them, about 8 came to us and said, hey, have you looked at Vistry, this thing in the UK? And I'd looked at a company that they had acquired called Countrywide. That was also a very popular name in the UK. Prior to that, Jeff Ubben had been involved in it, and Abrams Capital very briefly. And so we said, yeah, we'll have a look at it. And I really did go into it excited and wanting to own it, which is not always the case. Sometimes I'm going in skeptically. I went in here with a really optimistic bent, hoping it was what it was billed to be, what some people said it was. As part of that, I had listened to some podcasts and I heard some stuff that just struck me as strange. And this goes to the accounting part, John, where someone, I can't remember who it was. No, I'm not trying to critique anyone or anything like that, but and they may have made an analogy, but they said it was a cost plus model. And when I looked at the results historically, or if I looked at Countrywide, I knew that that wasn't the case. That's not how it worked. I can see how someone might make an argument for it, but it just wasn't the case. When I looked and I saw what had gone on with Fitzgerald, how he'd aggregated the company, I saw again 3 home builders, a huge geographic footprint in the UK. I'm obviously very familiar with the culture. Integrating a company that had done, I think, such momentous deals in 4 years, I thought was going to be a real challenge. You're dealing with lots of different people, lots of different standards. And culturally in the UK, the difference between the North and the South is just enormous if you spent any time there. So I was a bit suspicious there. And then when I went through their CMD, their latest CMD, and saw the claims they were making about unit volumes or what they hope to do, which is to get up to 30,000 or so at one point, 25,000 would be a disappointment. What they were claiming for margins, it just seemed a little strange, but we wanted to investigate it. What we found when we went through it was they were going to struggle on all the key variables, really. So, how we summarized it at the end was you can say this is a function of unit volume, margin, and the average sales price. And then you can apply an EBIT margin if you want. You can make it much more detailed, which we did. But on a simplistic level, that's where you're coming out. So can you get a handle? And this goes back to what we started with, and what I did in structured finance or looking at businesses this way from a risk perspective. What are the variables that count? And can you parameterize them accurately? So in this case, we could start off with unit volumes and we could look at all the home builders in the UK going back 40, 50 years and say, well, what have they done? What's it look like? And how easy is it to get to the target they're getting to? And when you look at that history, not easy at all. Very difficult. Nobody has done it. And especially not with a roll up play where you're integrating 3 different businesses. Then we try to say, well, are there different criteria? The argument that came afterwards was there's going to be huge stimulus from the government that's going to give people more propensity to buy. There's also going to be a relaxation of very restrictive planning rules that makes it easier to build. So you're stimulating both demand and supply at the same time. Will that grow? And they'd announced, I can't remember, it's a 35 or 39 billion program. People got very excited by this. So very narrative driven. But when you examined it, that program was over 10 or 12 years and it wasn't sure when it would start. And then if you break that down and you say the cadence is not even over time, you were looking at adding maybe 2 or 3,000 homes a year to the overall UK market from that stimulus, which it's not enough to move the needle if one company needs to go from, say, 17,000 homes per year, which is where Vistry was, to at least 25,000 to meet the minimum thing that they were hoping for. So when we looked at that, that didn't make a ton of sense. Also, there's been talk for 20 years about liberalizing planning standards in the UK. It is so difficult to do because it's largely a municipal problem, a local government problem, and the rules vary and it's very intensely political, as much, if not more so, than you'd see in the US. So it's a nice idea. People have promised it for a long time. It never seems to get delivered. And there's a final aspect to this that we didn't mention in the letter at all, just because, you run out of space. But if you look at affordability, disposable incomes were really being squeezed in the UK. Things were not easy at all. They were not getting any easier, and there was no sign that was going to happen. So, the commonest argument I heard in favor of looking at all the home builders, and this is a problem across the US, everywhere in Europe, Australia, you name it, in the Western world, it's a housing shortage, shortage of housing. Excuse me. That's fine, but that does not mean people can afford to buy a house if they're too expensive. So the disposable income was a major factor we looked at. We omitted it from the letter because it would take 3 or 4 pages, but that was not looking good. And the final aspect, which is in particular to Vistry, was they were focused on what they called partnership housing. They had moved, and this was the MBR thing, which is we're going to move to an asset-light model where we don't have to pay for the land. We're going to partner with local municipalities who need to build homes, council houses, if you like, or rental houses. And we're going to give them the land or give approval and they build it really quickly. Or it's a brownfield site, might be an old factory and we're going to clean that up. So we're going to have lower margins maybe by 4 or 5 points, but we're going to have much more rapid turnover of capital. So the ROCE is going to be enormous. That was the argument, and it's a nice thing in practice. But you had to factor in that the local municipalities in the UK are doing very poorly. They're financially in dire straits, many of them. So it was going to be a difficulty for them to fund this. And again, despite their best intentions, NIMBY, not my backyard, tends to win out, and people can stop things, and people weren't allowing for that. So all of these different constraints, when we looked at them, said, getting unit volumes anywhere near that's going to be tough. The other aspect, and this comes to the accounting side, was the nature of the model they had taken on. Again, I think people did not understand. So this partnership model is one where they win a long project. It can be anywhere from 5 to 10 years, but they are exchanging. It's true they don't have to have the capital up front for that, but they do have to act with speed. So they commit to a building plan. They make assumptions in that, the same way that you and I might if we were budgeting for a house up front. I think that it's going to cost me this much for labor, that much for materials, and I'm going to take 2 to 3 years. What they locked in when they locked in the municipality was, yes, they had guaranteed sales, but they'd also locked in a guaranteed price. That's where the cost plus comes in. It was not cost plus at all. So if they had made some mistake on what house price inflation was going to be relative to the build cost inflation, they had a problem with margins. So over 3 to 4 years, if the cost of their inputs was much higher than the inflation in house pricing, their margins were going to be much lower than they had allowed for. And what you could find very easily, you can just go to the CMD, was what margins they expected to make, or anyone expects to make, on these pre-sold homes or partnership homes. And that was around 18% on a gross margin basis. So that was about the best you were going to do, assuming your assumptions in your model when you started on the project were correct. If the cost inflation was higher than HPI, you're going to end up worse, and vice versa. All of the UK home builders, including Countrywide, which was it's now one of the components of Vistry, and Vistry, had experienced great margins throughout the mid 2010s or 20 teens, whatever you want to call it. And part of that was because home price inflation dramatically outstripped build cost inflation. That kind of reversed with Brexit, and it has not really gotten an awful lot better since. The issue you have here is Vistry was moving towards a model where they were aiming for 75% to come from the partnership model. And that means 75% of your gross margin is going to be 18%. Again, unless HPI is dramatically better than BCI. So when we looked at this and people were talking about 12 to 14% EBIT margins, which they'd experienced, I think, once alone, how do you get there? So if 75% of the portfolio is at 18%, assuming your assumptions about HPI and BCI were correct, how do you get there if OpEx is going to be 7, 8, 9%? And it could be dramatically worse. So when they had the profit warning, which is when we started looking at this, they had, I think, 3 in a row actually over the course of 4 weeks. The way the information was released was concerning to us. The fact that they didn't do it up front, it indicated they didn't really know what the extent of the problem was. It also indicated that there was something rotten in the culture underneath. And I don't mean to suggest the executives knew this. I don't think they did, or that they're bad people. They're not. Far from it. Greg Fitzgerald was an exceptional CEO, one of the best in the industry for a long time. But it does mean that integration of these mergers was not going well, and that the systems weren't working properly. And that's just, if you've any experience in business, like I mentioned at the outset, we've taken businesses private. Cultural problems like that, especially in large, disparate organizations with a large geographic footprint, it's very hard to reverse it. So we just looked at things and said, okay, if you correct for this, you can go back. The way the accounting is done, that they do a one-time catch-up. So they had a huge profit warning. They don't restate the financials. So if you looked at that, you could work out what the average margin was on an EBIT basis, and it was in the single digits, and not in a big way. It was 5 to 6%. And our fear was, very simply, when did they win most of the new partnership business that's going to be built, say in 27, 28, 29? Well, they won that in 22, 23. There's a long lead time for these projects. Is it possible that the mistakes that laid low their results and the margins ended up a lot lower, which was reality, or the future turned out different to what they had expected? Isn't it very likely, when they were making much bigger promises than they had prior to that, that they bid for projects with rose-tinted glasses? So they were as optimistic as they could be on the HBI, and as conservative and as unconservative as they could be on the BCI. That was our bet. So it wasn't that they're going to lose a ton of money or there's fraud or anything like that. It was just that the margins that they were hoping for and saying were possible seemed incredibly unlikely to us. So if you mix in unit volumes where I think it's very difficult for them to hit that target, and then mix in the fact that it's very difficult for them to hit the margins that they've been mentioning, and in fact, it could be dramatically worse, where do you go with that? I was open-minded to the idea that things could change. It could be that you do get revolutionary change in planning permission, but I want to see it first, not the promise of it. So yeah, much as we wanted to like it, when we ran it through that lens, it looked pretty bad. And there was one last thing that I think applies to all the home builders in the UK that I do think people should think heavily about, or weigh heavily, which is there are liabilities that are not immediately obvious, that if you look on Bloomberg or Capital IQ or FactSet or something like that, they're real liabilities that you should add to the EV, but they don't show up on the standard form. And the two of those are provisions and land creditor debt. So land creditor debt is where you agree you're going to buy the land and they in effect give you vendor financing. You don't have to pay that off until you start building. Provisions are exactly what you think they are. In the case of the UK, this became a major issue after the Grenfell disaster in London. So what they found was a lot of council housing, and again, that's where 75% of Vistry's business was going to be. They had not used the best materials for insulation, and other problems were discovered. So just to give Vistry as an example, and we highlighted this, I think, in the report, we'll let people make their own assumptions, but at the time we wrote about it, we had 2024's figures. I think they had reported actual debt, on the balance sheet of 501 million, and they had cash of 320. So 180 million of net debt doesn't seem so onerous. But if you added land creditor debt, that was another 740 million. And then if you looked at provisions, they were a further 352 million. And that was for a business doing adjusted EBITs of 330, 350. So the combination of those two alone was nearly 1.1 billion, or 3 turns of EV to EBIT. And all of the positive or bullish arguments we had seen for this was that it's just at a very cheap multiple. But that's excluding things that, at least to me, are their debts or their liabilities you're going to have to pay. The provisions are real. You're going to pay them. The land creditor debt is real. You're going to pay them the same as you would other debt. So yeah, that was, long story short, that's what was going on. And as we had looked at it over time, if I go back in time, provisions in 2021 were only 100 million. They'd grown again to that 350. Land creditor debt 516, grown to 740. And the final, I think, one for us in Vistry was we just never saw any of the cash really coming out relative to what they'd promised. They did some buybacks, but it was nothing close to the scale of what they wanted. So we were quite sad about it at the end. We'd done a lot of work. And then again, in an effort to be as transparent as we could be with our investors, we wanted to show them how we think. And, maybe we're wrong. Maybe it works out really well and we were just too conservative. Maybe we weren't. But it was a great case study for showing what we do, why, how we think. And that was the premise for it.
Well, very instructive case study there, Shaun. Thank you so much. A lot to learn there, whether one is interested in Vistry in particular or not. We will be wrapping up soon. Maybe we can hit the highlights on just one idea you had alluded to earlier, which is Edenred. But before we do that, I'll just mention that you did present Meyer Melnhof Carton at MOI's Best Ideas 2026 conference. That's available online, both on the MOI Global website as well as the Latticework Substack. So let's not get into that one, but maybe you can just quickly give us your thesis on Edenred. You mentioned it a little bit, but maybe just a 3 to 5 minute snapshot.
Yeah, sure. So Edenred, for those who don't know it, and I know that Jeff Stacey I think he had a great presentation with you, I think, on Pluxee, which is a very similar business. So it's a food card or fuel card business. If you're in the US, you may not know it. You'd be very familiar with it if you were from Brazil or from France or Germany or anything like that. So these are employee perks that are given out. They're a way of, I guess, giving extra benefits without it being so inflationary. So these are just, it used to be a voucher. It's now a card. And you can go, if you go to a restaurant or if you order food online through DoorDash, if you go buy groceries, you can use this credit instead of cash and it's issued to you at a discount. That's in essence what they do. Later on, they went into the fuel card business. So again, if you're in Europe, you'll have seen these things. It's for truck drivers or for us driving our car so you can expense it properly. It's a fuel card. And again, you get a discount and it gets processed. So that was it. In essence, Edenred is the biggest player there. They're probably the most innovative. It's a French company. The biggest companies in space all came out of France because they were the first to originate the idea of food cards and then fuel cards. This was done during very inflationary times as a way of not stoking inflation as much because it's not quite like cash compensation. So Edenred was enormous. They had a new CEO about 10 years ago. But what they realized was that they were very dependent on regulatory markets. So why do these food cards exist? Why is it not as inflationary? It's because for those traditional products, there was a tax deduction. So if you gave this to the employee, it was not taxed as income. So therefore, you could give them maybe a 10% rise, but it doesn't have that inflationary impact. And again, once these businesses got big enough, they could scale and get discounts in the same way that a DoorDash or an Uber Eats or Deliveroo might get a discount en masse from the merchants that it deals with at the restaurants. So this is a business that had done very well. It's got great characteristics. It's very asset light. It's a network effect type business. It had seen fantastic growth over 10 years, very good acquisitions. People loved it in 21, 22, 23. It got to very high valuations up to, I think at one point, up to 18 billion or so. Today, it's at a market cap of 4.5 billion and an EV of 6 billion. Why is that? Well, it goes back to what they were afraid of, which was these are regulated markets. So, in order for you to get that tax benefit, you had to obey certain rules. In some of their major markets, there was a big pushback against this. So, in Brazil, in Italy, in France, there was terrible abuse of smaller merchants at the expense of smaller merchants were burned to benefit large organizations, or that was the perception. So if you know the Rockefeller story about what he did with the rail cars for oil, where he would get a bigger discount, which would squeeze out his smaller competitors, there was a similar thing happening here. So if a small operator was using Eden Red service, they might be charged 15% on every transaction, but if it was McDonald's, it might be 1%. Think of it like the take rate, like you would for a delivery service. That was it. So what they did was they came in and said, well, there's a tax benefit with this, so we're going to cap the amount that you can charge to anyone to say 4.5 or 5% in the case of Italy. And then in Brazil, it looked like it was going to be that area, but it came out closer to 2.5%. And if you can picture the distribution of this across the marketplace, those large players are there just to give you scale. And for the customers or end employees who use your service, the smaller players need to be on there or else they're going to miss certain business. If you cut off that very long small tail that pays much higher premium and make the average 2.5, it's pretty catastrophic for margins. So they had this kind of horrible 18 or 24 months where Italy came in. There was a big case there, and they regulated, and people were very fearful. Then Brazil did something far worse, and then the French are debating it, and those are the three largest markets. So people freaked out about this. They said this is a company that was earning a ridiculous economic rent unfairly, all because of a regulatory protection that's now disappearing. It's under threat everywhere. And when we looked at the business, we just tried to invert it and say, actually, they've been increasingly diversifying away from these reliances. The regulatory impact in all of those countries or the change has already happened. So it's already priced in. We know what the impact is. So the event has already occurred. The horse has already bolted. And if you were just to value the non-regulatory aspects or impacted businesses, it's probably worth more than the EV today. In addition, a lot of the markets that are regulated are actually growing and growing in their favor. And the other aspect comes back to what we discussed on AI and intangibles here, which is, I guess, the secret sauce, or what people miss, in our opinion, is they have this enormous network. They have millions of merchants, millions of end customers. And what's unusual for them is they have 6-year contracts on average. So they have the opportunity to deploy many more services. So if you think of like a Groupon type thing, like you've seen in the US, they're adding that. So where 10 or 12 years ago, they might have had one product or two products, the fuel card or the food card. Now they've got an average of 2.2. In some countries, it's up to 5. And so they can just take advantage of this network and add more services at very little marginal cost. So we think next year, the business is going to make somewhere between 1.35 and 1.4 billion. And the company is today worth on an EV 6 billion or so. It's also got enormous float, $1.5 billion. There's a lot of value to that people don't really pay attention to. And then if you take company at face value, they think they can grow at 10% per year after this year, which is a trough or a transition year, through 2030. Then you're looking at a business, if they do that, that would have around 1.8 billion of EBITDA, very high margins. They're actually pretty good capital allocators. It's just hard for us to imagine a business that's grown on average maybe at 7% a year for 5 years, trading at around 3 times or 3.2 times EBITDA. So in a nutshell, that's what the argument is. I think it's just kind of misunderstood and people focusing more on a sequence of very bad news events and really on the wrong items.
Well, thank you, Shaun. That's great investment case there. I did also enjoy your investment case on Meyer Melnhof Carton, which, as I mentioned, is available online, and we'll share the link in the show notes. It's been fantastic to speak with you, Shaun. Lots of great insights, wisdom, ideas. Thank you so much for taking the time to join us and share with our audience.
The pleasure's all mine, John. I really appreciate it. It's always a joy to speak with you. And Elliot, I must say, I've been really looking forward to meeting you. I'm sorry I've droned on so much here. I hope maybe we can do it again sometime and I can listen more than I speak, because I really do have so much respect for you both.
This has been fantastic. Thank you for joining us, Shaun.
It'll be a pleasure to have you back anytime. Elliot, thanks so much as well. And we hope to be back fairly soon. Take care, everybody, for now.
Thanks, guys. Bye.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.